Welcome to Research Recap on JP Morgan's Making Sense podcast channel. I'm Phoebe White, head of US inflation strategy at JP Morgan. And today I'm joined by my colleague Mike Feroli, chief US economist. And we're here to discuss takeaways from the May US employment report, as well as the path ahead for the economy and the Fed. Mike, thanks so much for joining us.
Good to be here.
So that was a really interesting report. We had a pretty big upside surprise on the headline jobs gain, a bit of a more mixed message on the household survey. So what are your high-level takeaways?
Well, I think you kind of hit it, which is 272,000 increase in jobs was about 100,000 more than expected and about 100,000 more than we got the prior month. We also had some pretty good wage gains, another reversal of what we saw in April. But as you mentioned, the unemployment rate ticked up to 4%. Now it's up 0.6 from its cycle low. In addition, if you look at the household survey more generally, it's sending a rather different message. So over the past year, the household survey measure of employment is up just over 300,000, whereas the establishment survey, it's closer to 3 million. So it does paint two different pictures of the labor market. So I think, if I had to summarize it, it is that it looks like the overall momentum in labor demand is solid, but there are some things in the report to suggest, some caution is warranted in looking at these numbers.
Can you help us try to square the two different surveys and the different messages that we're getting? What are the sources, potential sources of the differences, and how do you read it?
So I think one thing is immigration. We believe that the census estimates of overall population growth, or there's good reasons to believe that those estimates are undercounting the number of immigrants. So I think immigration is one part of the story, which suggests that the trend level of job growth is probably a fair bit stronger than we thought. And I think the second thing is there's also some good reasons to believe that job growth in the establishment survey may be overstated. So we've recently received some of the benchmark data for the third and fourth quarter, which suggests that job growth last year may be overstated by about 50,000 per month. And we don't know yet if that overstatement is continuing on into the first 5 months of this year, but it's certainly a reasonable conjecture and one that would help us square the differing messages.
And it's interesting, just sticking with the supply side of things, it seems like the participation rate has pretty much been steady for a while now. So it doesn't seem like that's really contributing to the move up in the unemployment rate. And then, so I guess just on the immigration side, there's been a lot of attention on Biden's immigration policy this week and, the fact that this will be a very important issue as we approach the election. Any thoughts on how quickly we might start to see immigration slowing down and how that'll feed into labor market data?
Yeah, I think that's a big uncertainty. A lot of the commentary that has come out has been, I guess, skeptical that it's going to make a huge impact. We have seen the border numbers for April were a smidge softer than the year ago figures, but overall still running, quite a bit stronger than, 3 or 4 years ago.
Okay. And let me just turn back to, again, you had highlighted that, though we might get different measurements in terms of the pace of employment growth from immigration, that you could still take a signal from the unemployment rate, looking at some of the ratios, and that suggests that maybe labor markets aren't as tight as we thought. But then again, we still have a pretty strong average hourly earnings number this month, and that has been, still pretty solid, 4.1% over a year ago. So what are your thoughts there on kind of just squaring unemployment rate and the wage pressures?
Yeah. So yes, the unemployment rate is up. And I think we should also recall that earlier this week, we saw that the job openings rate has been coming down. So I do think the evidence continues to build that the labor market is coming into better balance. Now, as you mentioned, stronger wage gain this month. These can be very volatile month to month, the average hourly earnings numbers. I would say, you look at the year ago number, it's still generally trending lower. But I think what we learned from this jobs report is that, it's not going to be a straight path down and the pace of wage disinflation may take longer than thought, even if we remain confident that we're moving into better balance.
Okay. So what are your takeaways from this report, JOLTS, kind of a lot of the data we've gotten recently in terms of overall demand growth? Are we still on track for 2% GDP growth this quarter?
It does look like something around 2% continues to feel right. We'll have another retail sales report coming up soon, but that feels like a good number. I think Atlanta Fed now came down to 1.8 this week. So it feels like the right ballpark.
Okay. And in your forecast, you still have a step down in growth in the second half.
Yeah.
As you mentioned, things are gradually cooling. I guess just a question for you, where do you see sort of the biggest source of weakness in that growth path?
So certainly capital spending has been soft, and the most recent indicators don't point to that really reversing anytime soon. Business sentiment surveys generally continue to look subdued. So I think that's probably where we would continue to see softness. I think we got news last week that suggests consumer is cooling from what had been a pretty robust spending pace, but cooling to something that is, trend like 2% or so.
And is that largely because, pandemic era excess savings have been depleted? I mean, how much do you think that wealth effects play into this? Obviously, we have had an easing in financial conditions. How does that play into your forecast?
I think when you step back and look at the big picture on overall nominal labor income growth, it has been slowing, again, to something that is still a solid pace, but not as boomy as we had seen a year or two ago. So I think a big part of what we're seeing in consumer spending is just normalization from what had been, a very robust period in 21 to 23.
Got it. So nothing we should be too worried about in terms of an imminent
We don't see
break.
real big cracks developing. There are a few hints here in certain credit metrics of, rising delinquencies, but as of now, it doesn't look too worrisome.
Okay, so let's turn to next week. We do have the May CPI report on Wednesday morning, and then that afternoon, the Fed meeting. Anything you're expecting to see from the CPI report? It looks like consensus is around 0.3 on core CPI.
Yeah, we're also at 0.3. So in many ways, looking for a number not too dissimilar from what we saw in April, and we still think that the shelter components, the cooling there is going to be very gradual. But yeah, so we're probably a little bit of a high side on the 0.3 for core.
Okay, so assuming that report comes as expected, what do you think the message will be from the Fed, especially after this morning's data?
I guess the biggest, issue is going to be how they convey their intentions with the dots. As you may recall, in March, the median was looking for 3 cuts this year, though with a big minority in favor of 0 or 1 cut. We think it's going to be a close call between the median looking for 2 or 1. We're a little bit leaning toward 2, but as I said, it's a close call. I think away from the dots, the message both from the statement and from Powell, I think will be that, they continue to believe we're on the right path back toward 2% inflation, but that they can afford to be patient in waiting to gain greater confidence in that. Even if it's a message of, we're not cutting as soon as anticipated, I think it's going to be still a pretty overall satisfied message with how things are, playing out.
Do you think we'll see much move in the dots for next year or the long run dot?
So I guess backing up to March, in change terms, in both 25 and 26, the median looked for 3 eases. And that feels about right again for next week. I would say for the longer run dot, in the intermediate period, you have had a lot of commentary of the long run dot drifting higher, neutral rates drifting higher, and I would expect to see that perhaps next week where the median, which was I think 2.56, could move up to like 2.75. But I wouldn't expect any sort of discrete jump in those sorts of estimates.
Okay, so let's talk about your own Fed call and how quickly you think we'll meet kind of the tests that Powell laid out in terms of necessary criteria for feeling comfortable in easing. How long do you think it'll take to get there?
Yeah, so we had been looking for July. I think it's pretty clear after this morning's number that that's not going to happen, barring something really disastrous. And I think then the question is, could they gain that confidence by September? It's possible, but between now and September, there are 3 job reports. You saw pretty good momentum this morning, whereas between now and November, there are 5 job reports. I think within 5 job reports, we probably would see the softening or the broadening and the weakness that we saw in the household survey, such that the Fed would be more comfortable easing by then.
Okay, and then how are you thinking about kind of the path from there? Is this going to be more of a maintenance cut? We only get a few delivered, or is this going to be a steady series?
So we have been looking for basically a quarterly cadence of rate cuts. And I think even if the timing of the first cut is pushed back, I still feel pretty comfortable with looking for a quarterly cadence. So that's what, is going to be our expectation for next year.
Okay. So at this point, our Fed forecast is a little bit less for this year in terms of easing versus the market. We're back to pricing roughly 38 basis points of easing for this year. 10-year yields bounced today on the back of the report, but we're sitting pretty close to the middle of the range that they've held over the last couple of months, so right around 4.41 in 10-year yields. And if we're right and things are only moving gradually lower, we're probably going to stay in a bit of a range here. But with that, let me close. Mike, thanks so much for joining today.
Thanks for having me.
And thanks to our listeners for tuning in. We hope you join us again next month. For more research insights, visit jpmorgan.com/research.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. This communication is provided for information purposes only. Please read JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2023, JP Morgan Chase & Co., all rights reserved.